If you see along with the earnings, buyback is one thing that investors would be keenly watching out for. Now, this will be the company's fifth buyback. In the last 4 buybacks, the amount was close to anywhere between 16 to 18,000 crore rupees, and the company has usually deployed nearly one-third of their cash on books at that time for the buyback purpose. Now, the buyback price at that time was at a premium of around 18% to the market price back then, and the retail acceptance ratio is one thing that one needs to watch out for. Now, for the first 3 buybacks that TCS had done, the retail acceptance ratio was close to around 100%, but in the last buyback that happened in 2022, the retail acceptance ratio now that came down to just 24%. Now, if you see currently the company could have a cash of around 60,000 crore rupees on its book, assuming that one-third of this is used for buyback, the total buyback size could be anywhere could be close to 20,000 crore rupees. Now, assuming that the company buyback at a premium of around 18%, then the buyback price for of TCS could be anywhere between 4,300 to 4,400 rupees per share, which means that the company would buy back nearly 1.1% of the total capital. Now, but what's in it for retail shareholders? Now, if you see in the last buyback, the acceptance ratio had come down to nearly 24%. If that continues to remain the trend, even in this buyback, then the actual gain for any retail investor would be much lower, because even if we assume that the buyback is done at a 20% premium to the current market price, the retail acceptance ratio is just 25%, and the actual gain for any retail investor would be just 5% over a period of nearly 2 to 3 months. So retail investors might not gain much from TCS buyback if the acceptance ratio continues to remain on the lower side in the buyback.
All right, Swami, thanks for taking us through that. We will keep an eye out on TCS on that front as well. But TCS is also all set to kick off the earnings season, right? So which companies could see stellar profit growth this quarter, and which ones could see the maximum sequential profit decline? Swami, take us through all of that.
Culled out this list from the Bloomberg terminal, and we are looking at companies which have at least 10 analysts covering the stock. So what we are understanding is Greenply is expected to report the highest sequential growth in the net profit, but this is largely because the Q1 numbers were impacted owing to maintenance shutdown, higher raw material prices and the Gabon impact, and also because of lower demand in the first quarter. Now, UPL will also see a good growth in their net profit in the second quarter on a sequential basis on the back of improving prices and improving demand supply scenario. When it comes to healthcare global, now that stock would benefit on the back of better revenue per bed, occupancy and end of the one-time consultancy charges that the company had paid in the first quarter. Prince Pipe on the back of higher volumes and prices. Sobha would gain on the back of strong bookings and highest ever pre-sales number that it reported in the second quarter. When it comes to KEC International, it would be the moderating raw prices and higher sales which will aid the numbers of KEC International in the second quarter of FY24. Apart from that, if you see the companies that could report the highest sequential drop when it comes to the net profit, in fact there are 2 companies, Amber and IndiGo, which are expected to report a loss in the second quarter from a profit that they had reported in the first quarter. Now, for Amber, it would be the fact that second quarter is seasonally weak, hence potential losses. For IndiGo, it is weak air traffic, lower air ticket prices and higher crude prices that would impact the numbers. For Sudarshan Chemicals, if you see, it is a weak demand coming in from paint, plastic and packaging, which would weigh on the company's volumes and hence its net profit could be lower. For cement companies like Nuvoco Vistas and Shree Cement, it's the weak demand, lower cement prices and higher raw material costs that would impact the second quarter numbers. And for oil marketing companies like BPCL, HPCL and Indian Oil Corporation, it would be the weak gross refining margin when it comes to the refining business on a sequential basis, and also given the fact that because of higher crude prices, the marketing margins are also on the lower side, and these 2 factors combined would lead to a sharp drop when it comes to the net profit of the oil marketing companies in the second quarter of FY24.
Right, thanks for that, Somit.